Let me ask you something. Have you ever seen a company that, by all accounts, is just crushing it? Beating expectations, posting great numbers, but its stock price is just dead in the water? Well, that is the really bizarre story of the sports streaming service Fubo. And today, we're going to try and figure out what is really going on here.
So let's just dive right in. Fubo posts a really strong quarter, but its stock is completely stuck in this tug-of-war, hovering right around $2.67. So the big question we've got to ask is this some massive opportunity the market is just totally missing, or is there a hidden risk here that the headlines are ignoring? Let's find out.
So here's how we're going to break this down. First, we'll look at the conflicting signals the company is sending. Then, we'll make the case for a rebound. After that, we're going to uncover this looming debt deadline that seems to have the market spooked. We'll weigh whether this is a bargain or a trap, and finally, pinpoint exactly what you need to watch for next.
Okay, so let's start with the central puzzle, right? This massive disconnect between how well the company says it's doing and how the market is actually valuing it. It's a classic Wall Street mystery.
And this slide, this really says it all. Over on the left, you've got all the good news. Fubo's third quarter report was, frankly, fantastic. They beat expectations on revenue, on earnings per share, and on this key profitability metric called EBITDA. But then you look at the right, and what's the market's reaction? A total shrug, nothing. The stock price just isn't moving. So, what gives? To really get why some investors are so bullish on this thing, we need to look a lot closer at that good news, because this is the data that suggests the stock might be seriously undervalued.
Okay, first up, let's talk revenue. The company brought in over $377 million. Now, that number blew past what analysts were forecasting by almost 5%. In this tough economic environment, especially for media companies, a beat like that is a huge sign of strong execution.
And it wasn't just about sales. Fubo also beat estimates on profits, both earnings per share and EBITDA. Now, this is huge because it shows they're finally getting their costs under control. It points to a clear path to actually making money, which, is the number one thing long-term investors are looking for.
Now, check out this table. This is where things get really interesting. When you stack Fubo up against its competitors, it looks incredibly cheap. Its price-to-earnings ratio is way lower than the industry average, and as you can see, its price-to-sales ratio is a tiny 0.55. On paper, these numbers just scream bargain. The market is skeptical, sure, but if Fubo can just prove it can keep making money consistently, this stock could have a ton of room to.
So, if everything looks so good, why is the market so hesitant? Okay, let's pivot to the other side of the story and uncover the hidden risk that has investors on edge. And it all comes down to a looming deadline. All right, the key term you gotta know is convertible notes. Just think of it like a loan that can be paid back in two ways, with cold, hard cash or by creating brand new shares of stock. Now that flexibility might sound good for the company, but for existing shareholders, it can be a huge red flag.
And here's exactly why that's a problem. Look at the risk on the left. If Fubo pays its debt by just creating new stock, it's like cutting the same pie into more and more slices. That's called dilution. All of a sudden, your slice, your share, becomes smaller and worth less. What the market really wants to see is the option on the right. Fubo pays the debt with cash, showing it's financially strong and it's protecting the value of your shares.
Now, the amount that's actually due in February is pretty small, just $4.5 million remaining. But here's the thing. The market isn't worried about the amount itself. It's watching this as a test. How Fubo handles this one small payment will be seen as a huge signal of its financial discipline and how it's going to manage its balance sheet going forward. To its credit, Fubo's management seems very aware of this. The CEO, David Gandler, recently made a point of emphasizing that when the company repurchased over $140 million of these same notes, no shareholders were diluted. This was a crystal clear message to the market that they get it and they're prioritizing avoiding dilution. The real question is, can they keep it up? So all of this brings us right back to the central question. With these competing bull and bear arguments, is Fubo's current valuation a genuine, bona fide bargain? Or is it a value trap just waiting to spring on unsuspecting investors?
This chart shows you exactly what's at stake. You can see the stock has been trading near its low of around $2.44. The current price, that middle bar, is just a little bit above that at $2.67. But look at that third bar. Some analysts believe the fair value is all the way up at $4.50. That's a massive gap, and that is the potential reward if Fubo can actually get this right.
Now, to understand the risk, you have to look at these numbers. The things that were investors are right here. A current ratio below 1, which basically means they have more short-term debt than easily accessible cash, and the interest coverage is negative, meaning its operating profit isn't even enough to cover its interest payments. These are big liquidity red flags. But, and this is a huge counter-argument, look at that free cash flow yield. It's almost 15%. That means the company is a cash-generating machine, which is a really powerful weapon to fight back against all those debt concerns.
So, where does all this leave us? Let's wrap things up by focusing on the specific catalysts that will likely break this stalemate and decide which way Fubo's future is headed.
Keep your eyes on February 2026. Seriously, mark your calendars. First, you've got that convertible note deadline, the big test we've been talking about. Then, just a bit later, on February 27th, the company reports its earnings. That report is going to give us the freshest look at how the business is really truly doing.
The path for Fubo to win back investor confidence and hopefully earn a higher valuation is pretty clear. Number 1, handle that February debt payment smoothly with zero dilution. Number 2, keep improving those profit margins. 3, show that subscriber numbers and ad revenue are stable and predictable. And finally, number 4, deliver a confident, strong outlook on the next earnings call. If they can tick these 4 boxes, this stock could be in for a serious re-rating.
And so, we end up right back where we started, with a company that's executing really well, but is just haunted by this cloud of uncertainty over its debt. The next month or so is going to be absolutely pivotal. The final question is simple. Do you bet on the company's strong performance, or is the financial risk just too great? I guess we'll all be watching to see how this tug-of-war finally ends.